This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. Bob Michael joins us right now. He is with JPMorgan Asset Management, global head of, equities, bonds, currencies, commodities, I don't know, everything else.
Let's stick with bonds for now.
Let's stick with bonds for right now. Do you buy across the curve right now? Because simplistically, it is going to be price up, yield down.
So the product launch of the year isn't ChatGPT, it's the bond market. It's the repricing of bonds just across the system. And we are seeing money come in. And even though there's a soft landing cap, there's concerns about inflation, there's concerns that the Fed could keep rising rates indefinitely, actually, the highs from October, almost a year ago, have held pretty well in the long end of the curve, 5, 10s, and 30s. So it's not just me saying take advantage of the repricing of the bond market. We have clients left, right, and center, domestically, foreign countries, retail platforms, institutional platforms, looking at where to get into this bond market, and they are putting money to work.
Are they chasing income? Are they chasing total return, worried about a slowdown, taking on duration? How has the nature of that money shifted in the last few months?
Yes, exactly.
All of the above.
They're doing all of those things, and it depends where they're coming from. Wealth management platforms are looking at municipal bonds, they're looking at corporate debt, they're looking at treasury debt, and they're putting ladders of maturities in place. So they're buying bonds out to 10 years with maturities every 6 to 9 months, something like that. So they just want to get into the bond market before these yields disappear. Institutions, whether they're insurance companies or their pension funds, they're looking at their liabilities having deflated, and they're looking to put money into the long end of the market, and you have a whole host of others that are looking for total return. So you can do pretty much everything in the bond market. We haven't seen this since 2006, 2007.
There's only one sentence I heard in all of that: before these yields disappear. These yields aren't disappearing. They've been quite stubbornly high through summer. That's been unexpected for you, I know, Bob, relative to your call. What do you think's behind that?
Well, I think there are a couple of things. This reminds me a lot of the second half of 2021 when yields were ridiculously low. The Fed was talking about transitory. The market bought it. We were looking at inflation going up and saying, if they leave rates where they are, inflation's going to continue to accelerate. Now we're looking at rates very high. We're looking at very high real yields. We're looking at inflation coming down a lot. And the Fed is talking about leaving rates where they are indefinitely, higher for longer. I want to see the summary of economic projections. Is it tomorrow?
Next Wednesday.
Next Wednesday.
Yeah.
And the infamous dot plot. They've got 100 basis points of rate cuts priced in for next year from the last dot plot. And they've also got inflation coming down. So they're acknowledging that if they keep rates where they are and inflation comes down, then policy rates become progressively tighter and the economy may not be able to withstand that. I think what's keeping rates where they are is the market is believing the Fed rhetoric and not believing that they may have to cut rates.
Your previous call at the start of summer was cuts by September. Clearly they won't be cutting a week tomorrow. I want to understand from your perspective what's going to deliver those cuts. And when you're thinking about yields we haven't seen since 06, 07, some people might be listening this morning thinking, well, bad things happened after that. Do bad things happen now? And of course, I'm not saying on the same scale to the same magnitude of what we saw in 08, but are you anticipating bad things?
So at the start of this year, we thought something like recession by the end of the year. Then we had the regional banking crisis. And we thought, well, that's going to bring recession forward a few months, so they should be cutting by September. And I think what we looked at and probably got wrong was the backstop that the central banks the Fed put in place, the Bank Term Funding Program. And we likened it more to a Bear Stearns bailout. It probably was more like TARP. It just created more liquidity, backstopped the entire banking system. These things are still hiding in plain sight. The regional banking crisis hasn't gone away. I wish you had asked Bill Dudley when he was patting himself on the back in the Fed about, no, this is all in the rearview mirror. Really? Look at the Bank Term Funding Program. It's quietly increased in size the last 9 consecutive weeks. It's at $108 billion. So the regional banks are not working down their borrowing, and that's coming in at 5.5%. That's telling us that they still need cash available to meet depositor outflows. So I think there are plenty of things out there that are slowing down. Growth and inflationary pressures are coming down. For the Fed to pause, we've said for a long time, you need disinflation and inflation to come down to levels they're comfortable with. I think tomorrow we're going to get the third consecutive core CPI print at 0.2. That's enough for them to pause with a lot of the other disinflation that we're seeing. I think this time for them to cut rates, they're going to have to see unemployment go up. So it's possible that they may actually tip the economy into recession first before they start cutting rates, which would be something new for them. It would be positively ECB-like.
Well, okay, but going forward then, how does this cohere with a 3% yield curve across the board, a flat yield curve in the near future, by the end of this year, or even by mid-year next year? If you have a Fed that's being patient, not willing to cut, and you have economic data that's coming in hotter than expected.
Well, this is the Fed that promised us transitory and then within a couple months changed their mind and started hiking rates. We think we're going to see the same thing this time. They're going to tell us that they're going to keep rates higher for longer until inflation is at their target. But the magnitude of the slowdown we're seeing across the board tells us that we'll probably still be hitting recession around year end, so they'll be cutting rates by then. So I'm still incredibly comfortable that we'll see 3% across the curve.
Do you think high for longer is just a bad call, or do you think they're just misleading us, that that's what they want to signal currently?
I think it's what they have to signal, because they were already wrong once on inflation with the promise of transitory. They can't be wrong again. They're telling us that they're prioritizing inflation over growth. And that means, like the ECB, you're willing to make the economy a casualty.
I guess what I'm getting at is, do you believe them? Do you believe they're prioritizing inflation over growth? Or at the first sign of weakness, do you think they back away?
Well, I think the consumer is incredibly stretched right now. When you look at the Beige Book, you're seeing signs of that all over the place. They're talking about the last bit of pent-up spending on leisure travel. They're talking about consumers that are trying to maintain their level of spending since their excess savings have run out by putting stuff on borrowing, which is a very high way to finance yourself. So things are going to slow down pretty quickly. We look at news coming out of Truist where they're starting to address cost pressures by laying people off. So the labor market doesn't look as robust as that mid-threes unemployment rate. We think that starts to go up, and it will force the Fed's hand.
Bob Michael of JPMorgan Asset Management. What I was thinking about, Bob, and this goes back to the acclaimed toughest resume, toughest admit in banking, the analyst program of JPMorgan, is the real yield we're at right now began within the data that we have in the modern age in 2003. And that a huge body of our audience has never lived this rate structure and all of the follow-on to it. What's your counsel to someone, say, under 37, 36, 38 years old of how to address a whole new world after all?
Well, I think you have to understand that markets go through cycles. The cycles can be very long. Probably the last 15, 20 years weren't normal. They were the distorted years. They were the years that the baby boomers wrecked by over leveraging the property market, crashing it, and then taking a decade to repair. We think we're going back to an environment that is more normal, where there is a demand for capital, there's a use for capital, it's productive, and there will be a cost for capital again. but you don't get there all at once. I think a 525 basis point rate hike is a shock to the system. It will slow things down. We think the next move coming out of the Fed will be to cut rates. We think you go back to 2.5% to 3%. Yeah, the next tightening cycle, maybe they have to go to 6%. And you start putting in place the mirror image of what we saw in the late 80s and the 90s with falling rates. You may now see rising rates. So we have to get them used to inflation can be real, and markets have to price that in, and central banks don't always bail you out.
There's a lack of clarity in terms of how central banks really understand inflation. They say they look at core, and then headline starts to move sentiment, and then they start going after that. How much do higher oil prices, materially higher oil prices, play into the risk that the Fed remains higher for longer?
There used to be a wonderful chart everyone would dust off every time oil prices went up, that oil shocks create recessions. And it was another one of these 100% perfect predictors. And we're getting another oil shock at exactly the wrong time. After credit conditions have tightened dramatically, after the cost of funding businesses and households has gone up a multiple, we're talking about business and households having to spend on energy at a time when their real incomes are much lower. So they're going to have to cut back somewhere else. I think it actually is another one of these things that's a warning that recession may be more present than the market thinks.
When does it count as an oil shock? Because we are seeing prices normalize. They're not necessarily going to the highest that we've seen of this particular cycle, but they are the highest going back to last year. What's your tipping point for when it is prohibitive of growth?
Well, you have to look at the cost of production and the cost of getting a barrel out of the ground and where we are now. And what we're seeing is that OPEC is telling us maybe demand isn't quite there, but they're not willing to live with much lower oil prices. They want the volume to replace the demand. It's not there, so they're going to make it back with pricing, and they're going to push prices up. We'll see how high it goes. But for me, it's another sort of yellow warning flag out there. I don't think it helps the economy at all. I think it's another thing that squeezes an already stretched consumer.
Bracket the inflation-adjusted yield right now. At what level up above 2% does it really begin to impinge on the system?
I think coming off of several years of infinite free money, we're seeing it bite right now. We're seeing it in the housing market. We're seeing it in the cost of funding credit card purchases. You look at businesses, they front-end loaded a lot of their borrowing, but now they're going back and they're addressing other cost pressures. And they're not doing it by just borrowing more and absorbing the cost pressures. They're actually starting to cut costs. So I think it is now starting to bite. I don't think long and variable lags to monetary policy, that law has been repealed. I think it still takes time, and we're still in the early stages of it. I think the next 12 months are going to be pretty painful.
What would you have to see to make you change your view?
I'd have to see a legitimate reacceleration of core inflation. And that would tell me that we're in a different regime. Maybe the XYZ generation is large enough, they're earning enough, they're spending enough, that it is driving an economy that is going to a new high, and central banks do have to come in and really dial down the desire of the consumer to spend. But right now, we're not seeing that.
Are you Googling the XYZ generation? Is that what you just did?
Yeah.
What are you up to?
What is the XYZ generation? I've never heard of it.
XYZ?
It's the X, the Y one, and the Z one.
Yeah,
It's
no?
Gen X,
Okay.
Gen Y,
Oh, like combined together.
Gen Z.
So think the 91
hip, I
births.
can't keep up.
The 91 births are now the largest population cohort, and they're 32 years old. So that's the one. And if we go back to the financial crisis, they were 17 years old, and we wondered, how will we get through this before they replace the baby boomer as the dominant consumer? Now we're there. That's where we could be wrong. I don't think so.
They're the crew that, after the second REM album, they were never the same.
Thanks, Tom.
Yeah.
Bob, thank you. Bob Michael.
Pleasure.
JPMorgan.
Joining us now, Dr. Dudley. He writes for Bloomberg Opinion. Of course, all of his work at the New York Fed in definitive market economics with Ed McKelvey years ago at Goldman Sachs. Bill Dudley, thank you for this important essay. On the calculus of diminishing returns, how efficacious is a lift in capital requirements of our big fancy banks?
I think the question is, what problem are you trying to solve? Was the problem that we saw in the spring lack of capital among the big money center banks, or is it a problem with supervision, problem with bad accounting, problem with bank management? I think the problem is not that the big banks didn't have enough capital. If you remember, money was running towards the big banks during the turmoil that we saw in March, not away from the big banks. And none of the big banks got into any great difficulty in the United States. The problem with raising capital requirements over and over again is you're making U.S. banks less competitive, and that's going to push activity out into the unregulated non-banking sector. The question that creates is, are you actually making the financial system safer, or are you actually making it more unstable?
Should we raise the capital requirements of entrepreneurial upstart banks with a strategic gimmick to build growth?
Well, I think we certainly want to be very close, pay close attention to those banks that are using novel business models. And I think as the Fed itself admitted that we need better supervision. The problems of Silicon Valley Bank were identified in a relatively timely way, but then the supervisors didn't force the banks to make the changes necessary to prevent its demise. So I think that better supervision, more diverse stress testing, better rules on interest rate risk taking could go a long way to avoid these kind of problems. I'm not sure raising the capital requirements of the biggest money center banks by 15 to 20% is the answer here.
Bill, you talk about in your column the importance to recognize non-banking institutions as competitors, and that you really just increase their share by restricting the lending capacity of big banks. Should regulators be basically going down to the lowest common denominator of less regulated non-banks, or should they put more of an eye toward non-banks and regulate more closely some of those activities?
I think they should be focusing on what's the best solution for the resiliency of the overall financial system, banks and non-banks. Obviously, if you increase requirements a lot on banks, you're just going to have a bigger non-bank regime. And the question is, does that make you safer or does that make you more vulnerable? So I think there needs to be balance here. Also, I think that the real question here is what was the problem and what's the right solution to solve the problem? It's not clear that raising capital requirements on large money center banks solves the problems that we saw in March of this year.
Can we say that the banking crisis is over to the extent that it ever happened, and that going forward this is not going to be some sort of bigger financial risk that could torpedo the Goldilocks scenario, at least for the moment?
You never know, but I think that so far the knock-on effects of what happened in March are pretty modest. I think that's because it really was concentrated in a few banks, and it was all happening in plain sight. People knew exactly why these banks were getting into difficulty. They could see their interest rate risk exposure. They could see what's happening to their capital on a mark-to-market basis. So this is not like the great financial crisis where everything was happening in the shadows. People lost confidence in their counterparties. So I think so far, at least, it looks like this is a pretty modest knock-on effect to the real economy.
So if that's the case, and that isn't necessarily a headwind going forward, do you lean into this idea that maybe the Fed should be done and that we are looking at a scenario where they have the opportunity to just wait and take a look at the data on a longer and longer term basis to make any decisions?
I have no quarrel with the Fed waiting to get more information. I mean, they're pretty confident that monetary policy is at a restrictive level. If that's the case, it should slow the economy down. As the economy slows, we should have more slack in the labor market, and that should take away some of the upward pressure on wages and bring inflation down. I think the key question is, how restrictive is monetary policy today? It's possible that monetary policy is not quite as restrictive as the Fed thinks. And if they find that out over time, then they can obviously do more or keep rates higher for longer.
Bill, I want to finish there. You wrote about this earlier in the summer. I don't think it was picked up on nearly enough. I've been talking about it as much as I can. This quote from your column that read as follows, and I had the quote ready for you, Bill. There's considerable evidence that lags have shortened, meaning that the economy has already felt nearly all of the impact of the Fed's actions. Bill, talk to me about that evidence. Where do you see that evidence currently?
I think the most obvious piece of evidence is what's happening in the housing sector. The housing sector, obviously was hurt a lot by the backup in mortgage rates from 3% to 7%. But recently, the housing market looks like it's bombed out and isn't having any further weakness because of the rise in rates. The other thing that's important to note here is monetary policy works faster than it used to because the Fed uses forward guidance to guide the market, not where it is today, but where it's headed. So financial conditions, most of the tightening in financial conditions that we've seen over the last couple of years happened last year, not this year.
I remember, Bill, a conference that you and I did together with Mohammed Al-Arian in the summer of 2021. I think it was early summer, around June time. And you were both talking about how inflation may well be stickier than people think. And I remember you, Bill, threw out the number that maybe rates have to go to 5%. 5% back then sounded absurd. We're through 5. We're through 5. And we've gone right the way through 5. Bill, what are you thinking about now? Best case on where you think sufficiently restrictive might be?
I think that it's more likely that they hold rates here or maybe one more rate hike as opposed to go ever higher. I think where the market may be a little bit off base is to think that the Fed's going to ease a lot in 2024. I think the last mile in terms of getting inflation down, I think is going to turn out to be pretty difficult. And so I think that means that the Fed's going to keep rates higher for longer than people think. And I think that's one of the things that is feeding into the bond market and why bond yields have moved higher.
Bill Dudley, thank you, sir. Former New York Fed president and Bloomberg opinion columnist. Some fascinating insight there. Greg Boutle of BNP Paribas. He was the biggest bear on the street. He was looking for 3,400. He's now looking for 4,150. Here's the quote. The outlook for this year was always predicated on the idea of seeing a recession in the US. I think we've been surprised at the resilience of the data here in America. Greg, I'm pleased to say, joined us right now. 3,400 to 4,150. Let's start there. What do you feel like you got wrong, and why do you think that's going to persist?
Yes, I think there's been 3 drivers of the market that have helped this outperformance that we didn't see coming this year. One has been the Gen AI story. So that's a much more bottom-up story. So it's linked to tech and the appetite here to chase those names. I think the second one was positioning. We were aware that people were underweight coming into this year, but I think the extent of the chasing of the market that we've seen has surprised us. And the third thing, maybe most importantly, has just been that the data's been stronger than we expected. Us, along with many in the street, were looking for a slowdown and looking for a recession this year, and it just hasn't manifested, and really that's a big driver of the unwind of the gravity of the bearishness in our call.
You've reset. You're still looking for a negative market based on this call at 4,150. Where are you anticipating the weakness comes from, given everything you've just told us?
So I really think it is this manifestation of the slowing in the economy. So we know that everyone was looking for a slowdown that hasn't manifested as quickly as we expected, but that doesn't mean that it's not coming. The effect of the massive policy tightening that we've had is going to have an effect on the economy. It's just taking longer to percolate than people thought. This idea of excess savings being run down, we do think that the consumer is going to slow. So I think many of the reasons that we were cautious on the market, we still think a lot of that can manifest. It just might manifest at a slower pace than we'd previously expected.
You've been a complete class act on this reversal. I want to dig into it further, and that it's been led by 7 stocks. It's been led by big tech, among others. Ben Laidler, who's been dead on, a huge bull, says they will reaffirm and stay strong. With your new optimism, your new neutrality, and dare I say you're going to announce today that you're going to 5,000 SPX, are you going to do it with tech as a growth leader?
It's controlled pessimism at this point, I think. I think in terms of market leadership, it's hard to get away from tech. There is this structural growth story. So if we're in an economy that is slowing, albeit at a more gradual pace than we anticipated, then the structural growth stories are those that are going to outperform. The issue with tech is how far it's rallied this year. So I think the story going forwards in tech is going to be about being more selective. So we see certain subsectors in tech, things like semis, that have rallied massively this year, that maybe might pass the baton a little bit over to maybe software or some of the tech infrastructure names.
So I'm wondering about the concepts behind your bear case and your bull case. They follow kind of traditional economics, where bad news is bad news and good news is good news. The bad news being a hard landing, 3,400. The good news being a reacceleration, 4,600. Why don't you think that a reacceleration would actually prompt more aggressive Fed action that could torpedo the market? And in other words, the sort of good news is bad news and bad bad news is good news. I know that Tom's loving this. But, how much does that kind of come into play?
No, I think it's a really good question, because when we look at the correlation between equities and bonds, that gives us a bit of a window into that question. So you can look at bond ETF, something like TLT, so longer term treasuries, and you see the correlation between equities and bonds really broke down in summer when the equity market rallied, and we've had a pickup again in that correlation, which kind of points to me this idea that equity valuations are again looking stretched relative to rates, and that does raise the risk that if you get a hotter print, particularly in, say, this week's CPI, that higher rates could be a headwind for equities. So I think equities are stuck between a little bit of a rock and a hard place, in that an economic acceleration, if it's too hot, starts to bring rates higher, and that can again compress PE multiples. But a slowdown is really the bear case. I think our bull case is pretty asymmetric. We're not looking for that much upside. We think that upside would be driven more by value stocks and cyclicals. If we have data surprising to the upside, I don't really think that's going to help the names that have outperformed this year and driven the rally so far.
So do you believe in Goldilocks, or do you think that this is people just sort of wishful thinking and picking a point along a progression towards something else and saying, just stay there?
I think it's very difficult just to stay in this benign Goldilocks environment. I think one of the things that we got a little bit wrong this year was just underestimating this kind of piece in the middle. We had an issue with the data last year that it was way too hot. And our view was that data was going to cool and become too cold and take us into a recession. But ultimately, if you go from too hot to too cold, you go through a piece in the middle where things feel just about right. And that's where we feel we are. So we don't think the data is going to plateau here, and we don't think we're going to stay in this Goldilocks environment forever. This kind of controlled descent that we've had in the data, we think it's going to continue to deteriorate and will morph into a shallow recession.
My great theme has been corporations will adjust. How linked, based on what you've been through the last 18 months, how linked is economic analysis with the securities analysis of the market?
I think that equity markets are always very linked to the macro, but there are these secular drivers that sit alongside that. When we go and look at any of the large crashes or bear markets over the last 100 years in equity markets, they're all accompanied with a swift economic decline. But that doesn't mean that we can't have these secular themes, things like Gen AI, that drive some dislocation. So I think part of it is the magnitude. When you're in a more benign economic environment, the economy is not necessarily the primary driver for the market. If we do get to a situation around the turn of the year where we start to see negative payroll prints, then I think people's attention will divert, and people's ability to buy into blue sky thinking becomes much more challenged.
Are you allowed to talk about Apple?
We can talk about it loosely. Obviously, I don't cover
Let me loosen it up. Let me loosen it up as follows. Dollar stronger. China perhaps developing different tastes, nationalism shaping perhaps some patriotism at home away from foreign luxury items. Are multinationals in trouble here with exposure to China?
So I think how I can answer that is think about some of the general themes that we think about in terms of tech. Those stocks are going to be incredibly resilient in a downturn. Why? Because they have great free cash flow and amazing balance sheets. But that also doesn't mean that they are immune from a consumer slowdown. So one of the things that we think will manifest over the next 6 months is that this tightening of rates will affect the consumer. Now, the consumer is obviously, consumer discretionary is your first port of call, but there are a lot of tech stocks that do face the consumer. Ultimately, Apple sells goods and services to the consumer. So will they be entirely immune from a cyclical slowdown? That's the question.
It's like one more thing, except, it's encore une chose. When you're BNP Paribas, you say that. You say that.
That wasn't a great song as well.
I think
I'm sure that was a song, wasn't it?
Yeah,
sort of like 90s club music. Yeah. All right. Greg, thank you. Greg Boutle.
Encore une
BNP
chose.
Paribas.
To help us with Brent at 90 and on the reality of Saudi Arabia and $100 oil is Francisco Blanch. He's head of global commodities and derivative research at Bank of America Global Research. Francisco, you nailed oil. You got your 90, 91 Brent as well. The trajectory seems to be to 100, and very clearly that's what Saudi wants is a domestic reality. They have budget requirements, fiscal requirements domestically. Are we going to see a $100 barrel because Saudi wants it?
It's possible, Tom. I would say there's three things that have been moving oil prices over the course of the last 3-4 months. Supply, and supply. We've had Saudi Arabia cutting production for, as you know, close to a year now. And they started cutting in September of 2022 at around $95 a barrel on Brent. So clearly they want to have higher prices. They're trying to push the market there. What's new in the past few months is that Russia has finally started to align itself with Saudi Arabia and started to take production out. The Russians, after maximizing volume over price, over value for much of the past 12 months, they started to focus on price over volume. And that's a new development in Russia, I would say, in the last few months. And then also we've had a lot of refining issues, Tom. We've seen products, particularly diesel, leading the oil market higher. So those are the three main supply drivers.
One of the great things in Calvin's book is the new linkage, not like 1986, but the new linkage between Saudi Arabia and China. Can China live with $100 a barrel oil?
Well, I think that the Saudis have always been very cautious about avoiding demand destruction episodes. And certainly, I think they will become cautious again if prices break through $100 a barrel because as we saw last year with gas, with natural gas, if prices do get out of whack, you can lose a lot of demand. European natural gas demand from industry, remember, is lower today than it was at this time last year with a 90% decline in prices. So you have to be careful what you wish for. If prices move up too fast, you can end up hurting consumption. And China today, as you know, is the world's largest oil importer by a mile, and is facing a pretty weak economic outlook ahead because of the real estate challenges and the trade war with the U.S. and, of course, the tech sector also being down. So I think China is not in a great economic position to begin with. So I think OPEC Plus will be careful as prices rise.
Before we drill into the demand side, let's sit on supply just a little bit longer, Francisco. You mentioned a shift in Russia, away from volume to price. What's underpinning that shift? Is that well understood before we make a call about how durable that pivot will be?
In my mind, the pivot comes after a very successful program set up by the U.S. Treasury to put a price cap on Russian oil. Remember, the price cap essentially encouraged Russia to export high volumes at low prices, which were then resold, redistributed across mainly India and China and other clients. But more recently, I think the Russians have figured out that the ruble is too weak, that the Russian tax authorities haven't been able to really raise enough revenue. And the macroeconomy in Russia has really deteriorated. And of course, we've seen that with tensions building up within the military and the paramilitary over the course of the past few months. So I think the conclusion that I believe the Kremlin is probably arriving to is that they need more money. And therefore, the way to do that is the way to maximize revenue for the Russian tax authorities has been to pressure volumes lower and allow prices to rise. And the price of Urals crude oil, which was trading around $50 a barrel, is now approaching $80, well above the price cap set out by the U.S. and the European Union.
On our screen right now, Brent Crude through 91. So, Francisco, let's talk about demand and build on the question Tom asked. It's an important one. Have we seen any sign of deterioration in demand from China, even with that economic weakness?
Well, the August numbers were phenomenal in terms of import increases. We saw China importing 12.5 million barrels a day on average throughout the month. Granted, imports in July were kind of weak. But what we hear from China, and I was in Singapore last week and at meeting all the various energy traders, the main message is that Chinese demand is pretty healthy. And to be honest, you see it in the data. You look at a number of air flights, you look at passenger traffic. Demand is still pretty healthy. What's been weak is industry-related consumption. So think about gas, oil, diesel, and the petrochemical complex. That's been weak. But I think overall Chinese demand is in a better place. I think even though the real estate sector is not doing well, you still have a strong services sector come back after COVID, and that's supporting oil prices in China and crude runs as well. We've seen refineries running a lot of crude oil in China over the course of the past few months. So I think Chinese demand for oil is continues to lead, frankly, the world. Most of the demand growth this year and probably next year will still come from Asia and China will be the bigger part of that.
This goes against the narrative, which is that China's falling off a cliff, not demanding anything, and that this is entirely driven, that the increase in prices in oil is entirely driven by what Saudi Arabia is doing and maybe on the margins, what Russia is doing. If we don't have that narrative, what would stop oil prices from going higher, especially if demand continues strong from China?
Well, I mean, I think, look, China overall, like I said, is coming back from COVID. If you look at international flights, they're still down 50%. Now, there's been a lot of tension between the U.S. and China over the course of the last few years, right? And for instance, flights to the U.S. remain very, very suppressed. But that's going to have to pick up. And we're also going to see a meaningful increase in China flights to Europe over the course of the next few quarters. So in my mind, I think the Chinese demand story from a services perspective is okay. I mean, GDP in China is not negative. I mean, it's weak, but weak means 4%, 4.5%. That still allows for growth in kind of the same things we did after in the West when we came out of COVID. Restaurants, going to the movies, traveling around. I mean, the Chinese consumers are doing that, and that's supportive of the oil market. And then, of course, to your point, I mean, the curtailments on OPEC have elevated prices, have brought inventories on a downward trajectory, and we expect that to continue. So again, we are targeting $90 a barrel on Brent for next year. That's the current market right now is at 86 for calendar 2024. So there's a little bit of upside in our view from current prices. But I think if you push too hard, the risk is that inflation comes back. And then the narrative that we're going to have peak rates with no recession goes out the window in my mind, right? So I think OPEC has to be considered also about, consider the effects on the macro markets, particularly rates and the outlook for a potential recession in the U.S. and the rest of the world.
Hey, Francisco, always a clinic.
Right.
Thank you, sir. Francisco Blanch of Bank of America.
This is a joy to do this in remembrance of how people stepped up big time in early 2020. I have a clearest memory of our first interview on COVID. It was with an acclaimed radiologist from Mount Sinai in New York who brought into our studios X-rays from China showing the outside lung damage that COVID could wrought. Johns Hopkins helped us so much on this. And joining us now in the booster uproar, Bhakti Hansoti, to say she's Associate Professor of Emergency Medicine barely describes the global parchments, the study, the academics of Professor Hansoti. Bhakti, great to see you again under always COVID difficulties, to say the least. When we were kids, it was routine to get a booster shot. Is an mRNA booster shot any different, any more dangerous, any more at risk than a tetanus booster shot of my childhood?
Absolutely not. The current new vaccines are not technically boosters, are updated vaccines that are targeted to the current viruses that are circulating, but they're equally safe. These vaccines have full approval, i.e. they've gone through all the scientific rigmarole to ensure that they're safe and effective for the population.
Bhakti, I look at the science here, and it seems in order. I'm basically appalled at the government response, the messaging from the White House to get behind the science community. What do you need from the president? What do you need from the administration to build confidence in this booster program?
So I think we clear messaging. This is full approval, number one. Two, we need to hear from the CDC today. They will be deciding who should get the booster, who do they recommend, but also the reasons for those recommendations. Why is that the current recommendation? And what are they trying to do by making this recommendation? Are they trying to prioritize those at highest risk? Or are they genuinely saying that the vaccine is only recommended for those people it will benefit? So we need clear communication, clear logistical reasons as to their recommendations. And the third is we need to make sure our supply chains are strong. So we need to make sure this vaccine comes out later on this week, that folks know where to go, that folks can access the vaccine quickly and effectively.
How much did the administration and policymakers really set themselves back by trying to clamp down on the message so hard initially? There was just a court ruling saying that the administration did overreach in trying to strip away any anti-vaccine messaging. How do you view that in light of what you're trying to put forward right now?
So we view that because it has this paternalistic attitude to health, right? But we are all informed partakers of our own lives, our own health. We have access to information, some good, some bad, some here, some elsewhere. And so by having communication that is more robust, that's less black and white, that allows for effective dialogue, that allows individuals to buy into the whole the interventions, the vaccines, the therapeutics, the masking. And so what we need is to ensure that there's dialogue, that there is debate, that debate has a scientific foundation.
There's also been a lot of discussion about side effects for the vaccines, in addition to how much they actually prevent you from getting more sick. If you're going to still get sick and you've already had it and you're not going to die, there's this sort of feeling, what's the point of increasing the potential risk if on the downside you could just spend another day in bed? What's your view on that?
Absolutely. So first of all, the FDA would not approve a vaccine where the likelihood of you being sick is greater than the illness itself, right? That is just not going to happen. So the side effects of the vaccine do exist, but they're over-reported, partly due to the media. We over-report rare events that can be dangerous. As far as the illness from COVID-19, it affects different people differently. So if you have multiple comorbidities, you have existing lung conditions, you may in fact require hospitalization. Hospitalizations went up by 8.7%. So it's not as if this disease is a benign common cold where you're just going to spend an extra day in bed. I had the pleasure of treating several patients over the weekend at Johns Hopkins Hospital Emergency Department, and the majority of my patients went home, but some patients did require admission. A lot of patients reported that they were fatigued, exhausted, couldn't go to work, couldn't manage their activities of daily living, couldn't look after their dependents. So if you're responsible for a family, for children, elderly parents, or you need to go to work, then get vaccinated. The chance of you doing that is much greater.
How is this different from the flu?
Not significantly. The flu has the same constellation of symptoms: fevers, chills, colds, congestion. COVID will present the same, as will RSV. And that is the challenge here. COVID illness will likely be underreported because some people may assume that they just have the flu. And that's okay as long as you're staying at home and isolating.
Dr. Hansoti, what is the science of masks? I don't want the politics. I don't want the mumbo jumbo. I can't stand them, full disclosure. But what is the science of masks in this COVID of 2024?
The science of masks is when masks are worn, they are effective at preventing onward transmission. A lot of the literature that you're seeing right now misinterprets the data and how the data was collected. A lot of the data is in non-COVID eras, in individuals who are not accustomed to wearing masks. But the data from COVID during masking in healthcare facilities showed that there was very little healthcare worker to healthcare transmission when healthcare workers were wearing masks, even if they were COVID positive at the time. So the science shows that masking works. I also hate masks. My patients feel better when they see my face, they see my smile. I'm able to reassure them during their illness. So I currently am choosing who I mask and who I don't mask with. If someone does not have upper respiratory illness or flu-like symptoms or is not immunocompromised, I'm currently, right now, this is today, I'm not masking. In the future, I may change that if COVID-19 cases continue to increase.
We want to see you smiling without a mask. Doctor, thank you. Dr. Bhakti Hansoti there.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.